Hey there, this is Bill with smarttrades.com. Today is July 1st, Sunday. It's around 2:15 p.m. Pacific time. And let's start off with the S&P from last week. As always, if you would like more frequent updates, please visit me at smarttrades.com. And today we're going to do a bit of a review, actually, of the reports from last week, both on the video and as I reported on my newsletter, again at smarttrades.com. Here's the report from last Sunday, and you can see here we've got this labeled as A up, possibly looking for a B down, and then C back up. Here's how things actually worked out. I do have some questions whether or not B is complete here. That said, the momentum to the upside does favor, at least short term, some higher prices, but it is possible we may yet still carve out a somewhat lower B wave as initially projected there. Anyway, resistance is at around 1375 to 1380, and then up around 1400. That's the ideal A equals C, or if you prefer labeling this WXY, the W equals Y scenario would come in around the low 1400s. Certainly possible we'll retest 1422 if indeed this is a B wave. A rally up to the 1400 plus area doesn't negate the possibility that this rally is a wave 2. Again, that's a potential alternate count here. 1 down, ABC 2 back up. But as you get deeper into the retracement levels, it becomes more likely that, at least from my experience, that it's a B wave rather than a wave 2. Here's the Dow projection from last week and the count there. Here's how things have worked out so far. Basis the Dow, an A equals C comes in up above the 13,000 level. That would be an ideal scenario for a flat type correction. Please remember that the Dow actually, although it can be counted as 5 down, can be counted other ways as well. And the high to the 13,330 level or so in the Dow was actually an ABC rally, which is different from the S&P, which made lower peaks on that corrective looking rally. So something to keep in mind, the possibility that this entire pattern off of the highs from March and April and May are corrective in nature. Here is the Euro chart from last Sunday, projecting third, fourth, and fifth waves to a possible C wave bottom. Here's my update on my newsletter, and here's how things worked out. The market did indeed go a little bit lower than our initial projections. That said, the basic wedge type decline held, and in fact we basically nailed the lower end of that wedge type trend line before exploding overnight on Thursday morning and during the day Friday. Here is the report from last week in gold. We were looking for again a fourth wave rally and then a wave 5 down to complete a possible C wave. Here's the update on my newsletter with the triangle, which actually added further confidence to the count because likely in that position that triangle is a fourth wave. And here's how things worked out. I'm often asked about how to trade these patterns, and one nice thing about the futures is that they trade basically 24 hours a day. And so oftentimes, even after the stock market is closed and the ETFs are closed, you still get an additional pattern. Interesting here, we've got a nice set of 3, 4, 5 down, 1, 2 up, and that coincides almost perfectly with a little tiny reverse head and shoulders type bottom. The idea here is to buy the breakout of wave 1, or the neckline, if you will, if you want to call it a head and shoulders. And your stop would go probably the safest place to put it is below the bottom of the entire move, although you could put it just below this little wave 2. The danger there is that this rally is a B wave and you may come down one more time before going up, even if you're right, and risk getting stopped out. That said, to my way of thinking here, what I would do is trade this breakout and then ratchet the stops up at least on half the position. one of the major problems or fears that people have with the futures markets and commodities is the leverage, and indeed it's something that you need to respect and be careful about. That said, if you if you do want to trade them, there's an advantage of being able to run stops overnight when the stock market and the ETFs are closed, and in that respect you may actually have less risk, assuming that again you're using a position size wisely. Here indeed is the GLD, and you can see again here's our nice breakout buy. You could have put ratcheted stops up overnight, and with the GLD you could have certainly bought down here off this low, but you would have never had that nice 1-2 setup. More than likely you would miss the move if you're waiting for that, obviously, and you wouldn't have been able to ratchet the stops up overnight. Here's the crude oil chart, again from last Sunday, looking for 5 waves down on the daily chart. Here's my update on my newsletter. Again, there's that wave 4. It's a 240-minute chart, and then 1, 2, 3, ABC 4, a 5th wave down. And indeed, here's the rally on Friday. Once again, here's that pattern that you see in gold, very similar, although not the perfect symmetrical head and shoulders type bottom in the crude oil futures, and the breakout buy, and a really nice rally in crude oil overnight and into Friday. And again, here's the problem with the ETF gapping up, and unless you had just bought this on these lows, likely you would have missed the move if you'd waited till Friday morning. Here is the long-standing fractal count on the S&P weekly chart, and again the projection for a possible peak out in February of 2013. Keep in mind, that's a long way out, and predicting the future is a tough business. So, I do reserve the right to, as more data comes in, to refine this count or change it altogether. That said, something interesting to note is that if you look at this as a series of head and shoulders type patterns, you have a very small one here, and again the larger fractal type pattern looking very similar in terms of the head and shoulders type count, and equality in terms of time in the right shoulder to the relationship of the left shoulder to the head comes in early March of 2013. So a little bit later than the perfect fractal relationship within this smaller pattern, which again I've mentioned in previous updates. If you'd like more information on that, please review the fractal analysis of some of the past videos. But again, that sets up rather nicely. Now, if you have a head and shoulders projection, it would take us down into the low 700s, a 2.618 times this leg down, the break into the later part of 2011. That was on the debt crisis fiasco. And anyway, 2.618 times that takes us down to around the mid 600s. So both of these give us that general area. Again, there's, as I've mentioned before, there's quite a bit of support in the 1,000 area basis, the Dow. And if we start breaking through that 1,100 area, I would revise this count and look at the possibility that indeed we've already peaked. It's certainly a possibility, and again, I reserve the right to update that as more data comes in. But this gives us, just an interesting symmetrical roadmap. You've got the fractal nature of this market, both in terms of the really fine details in 2011 versus the rally from the 2011 low up to the recent highs, and it just all fits together rather nicely. So worth looking at, and again, let's see how it works out. But so far so good, and at any rate, hope you're having a good weekend. Let me wish you a happy 4th of July week in advance, and good trading ahead. Thank you so much for watching, and again, visit me at smarttrades.com if you would like these updates during the week. I update, pretty much every day through the newsletter, at least 3 or 4 times a week, and I update daily and intraday via Twitter as well. If you like the video, please acknowledge that here on YouTube. And thanks again for watching. Bye-bye.